Fast and easy investing for beginners. Setting investment goals. Setting investment goals is a fundamental step for any beginner looking to navigate the vast waters of investing. These goals will serve as a roadmap, guiding decisions and influencing strategies throughout the investment journey. To begin this process, individuals should first differentiate between short-term and long-term goals. Short-term goals might include saving for a vacation or a new car within the next couple of years, while long-term goals could involve retirement planning, funding a child's education, or building wealth over decades. Best practices suggest that for liquid savings meant to cover unexpected expenses, one should have a reserve that covers 3 to 6 months' worth of living expenses in an easily accessible account. This emergency fund acts as a financial buffer, allowing investors to pursue longer-term objectives with greater peace of mind. Once the immediate financial safety net is established, individuals can shift their focus towards longer-term investments that require a more strategic approach to asset allocation. Diversification plays a crucial role here. Spreading investments across various asset classes such as cash, stocks, bonds, and real estate can mitigate risk. Since different asset types react in distinct ways to market fluctuations, interest rates, and inflation, a well-diversified portfolio helps to stabilize overall returns and reduce the adverse impact of any single asset's poor performance. For instance, growth stocks may offer higher returns potential but come with increased volatility and risk, while income stocks typically provide steadier dividends from mature companies. Moreover, understanding asset classes also involves grasping the distinction between domestic and foreign investments, as well as recognizing the varying characteristics of companies based on their size or market capitalization. This strategic understanding enables new investors to make informed choices geared towards achieving their specific financial goals and to effectively manage the risks associated with their investment portfolios. As the investment landscape continues to evolve, maintaining a clear set of objectives will aid beginners in adjusting their strategies in response to changing market conditions, ensuring they remain on track to meet their dreams and ambitions. Investment strategies for beginners. Investment strategies for beginners are crucial in understanding how to effectively grow wealth while minimizing risks. Two main strategies dominate the landscape: active investing and passive investing. Active investing involves continuous buying and selling of stocks in an effort to outperform market indices. This strategy often requires the expertise of fund managers, which leads to significant fees that can erode profits over time. Studies indicate that the majority of active investments tend to underperform compared to passive strategies, particularly after accounting for taxes and fees. Hence, for novices, active investing might not be the most prudent choice due to the complexities and costs involved. In contrast, passive investing focuses on a buy-and-hold philosophy, aiming to replicate market returns over the long term through index funds or exchange-traded funds. By investing in a diversified portfolio that tracks market indices, beginners can significantly reduce costs associated with frequent trading. Passive investing is often touted for its simplicity and effectiveness, especially for those who lack extensive market knowledge and are unwilling to take on high levels of risk. It remains important to note, however, that while passive investments can provide exposure to market returns, they do not guarantee profits, particularly in down markets. Additionally, understanding the nature of risk is essential. Investors must be aware of compensated risks, often linked to fixed income securities, and uncompensated risks that pertain to equities. Ultimately, the choice of investment strategy should reflect an individual's financial goals, risk tolerance, and investment horizon. Beginners may benefit from adopting a more passive investment approach, allowing for potential growth with lower management costs and reduced stress. As they gain experience and knowledge, investors could consider diversifying their strategies. But a firm understanding of the inherent risks and returns in each approach is vital for long-term success in their investing journey.